Today, I want to talk about my updated AMC squeeze brackets. I want to start by discussing the facts on why I'm still confident on the squeeze. I want to explain the current catalysts that will cause the squeeze and rank them from most to least likely. And then finally, I want to go through my actual brackets. So stay tuned and let's make some money. And now I'll dive straight in with the key information. So, fact number one is that retail investors have not left. Back in 2021, Adam Arons confirmed there was 4 million individual retail investors. And only a few weeks ago, Adam Arons reconfirmed that that number still sits as high as 3.8 million. It's not like that number has fallen significantly from 4 million retail investors down to only 250,000 holders. No, that number is still just as high as it always was, right up at 3.8 million. Fact number two, from our calculations through Twitter polls with sample sizes as large as 15,000, the float seems to be held multiple times over. Now, this is something we've always suspected, but actually it seems like the number of synthetic shares in existence has increased significantly over the last 2 years. We always assumed the float had been sold at least 4 times over, aka with 1.5 to 2 billion synthetic shares, but now it seems like the float has been sold up to 8 or even 10 times over, with potentially as high, if not higher, than 6 billion shares total. Cat Striker's poll here at the time of the screenshot had 8,000 votes and still 17 hours left on the poll. I think if you check it now, obviously the poll has expired and there was a total of 15,000 or 16,000 individual voters. Now, obviously this poll isn't quite complete as it doesn't contain all of the categories, but even with some very rough, very bottom of the barrel, very conservative calculations, the float is still sold at least multiple times over, with at least 6 billion shares. So basically, retail investors are still here. Retail investors have been adding to their AMC positions, and therefore the float has been sold multiple times over, and many more multiple times over the last 2 years than it was back in January or June of 2021. Fact number three, the AMC FTDs are still spiraling out of control and it's getting significantly worse. Obviously, in the first few weeks of April, we saw over 16 million FTDs on 2 consecutive days. Now, Wikipedia and Investopedia do say that failed to delivers are indicative of synthetic short selling, which again is another fact. Another fact on top of that, these short positions are costing the shorts hundreds of millions, if not billions of dollars. The cost to borrow maximum for AMC and the cost to borrow average and minimum regularly sits over 1,000%. Now, obviously, it doesn't always sit at 1,000% exactly. Sometimes it's only 621%, sometimes maybe only 300%. But what we do know is that this is significantly higher than 1% per year, and the shorts are paying multiple times their total short position every single year in annual fees. Another fact. Fact number four, everything that I spoke about back in December of 2021 is coming true. The economy has got significantly worse, and now it's got to the point where multiple banks in the US are failing and have already failed. In just the 3 banks alone that have collapsed in the last few weeks so far, they've already had more assets in total than all of the banks that failed back in 2008 combined. The economy, or specifically the banking system, is in a very fragile state, and everything in that entire financial industry is falling apart. In my video tomorrow, I want to talk about how tremors in the hedge fund sector could threaten the entire economy and how hedge funds have just 72 hours to report any major losses or credit events they've experienced recently. But on the flip side, fact number 6 or fact number 5 or whatever fact I'm on, AMC, on the contrary to the wider economy, is actually improving significantly. As Adam Arons tweeted, he has a sizable cash position at AMC, which again is another fact. AMC has been improving their revenues, reducing their costs, and therefore trying to improve their overall profitability. Again, another fact. But now let's also talk about some catalysts and rate them from most to least likely. I think catalyst number 1, being the most likely to happen, is that Citadel goes bankrupt as a result of the current banking crisis, very similar to how they very nearly did back in 2008. I want to start by showing you a small extract from this video where Ken Griffin talks about how Citadel nearly went bankrupt back in 2008, how they were just days, maybe even mere hours away.
We were losing hundreds of millions of dollars a week, if not more. CNBC parked a van in front of Citadel, waiting to break the story of our demise. But we weren't going to give them that story. You see, each day, we took the steps needed to keep our business going. We sold assets. We closed business lines. We let people go. We suspended redemptions. Our management team absorbed $500 million of costs on behalf of our investors to demonstrate our commitment to the business and our belief in the future. And each thing we did bought us one more day. And day by day, we bought ourselves a future. Often the choice was between painful and more painful. But the one thing we didn't do was put things off. By the end of 2008, we had lost half our capital.
So what Ken Griffin is saying there is that back in 2008, with a banking crisis this bad, Citadel lost half their capital and very nearly went bankrupt, trying to survive on a day-by-day basis. Now, can you imagine what would happen to Citadel if there was another banking crisis that wasn't just this bad, but if it was this bad, or maybe even this bad? And obviously the crazy part is that right now we're in 2023 and we already have a banking crisis that is already this bad because the assets or total losses have already equalized that of 2008, and it's likely to be getting worse and worse. Therefore, I do think if this current 2023 banking crisis does continue getting worse, that Citadel is practically guaranteed to go bankrupt as a result. Now, catalyst number 2, which I think is slightly similar to number 1 but slightly different, is that Citadel ends up failing their margin calls as a result of the current or continuing market crash. As I said, if this banking crisis does get worse, the market will continue falling further and further, Citadel's margin position will continue getting smaller and smaller, and they will eventually fail a margin call and be forced into liquidations. Catalyst number 3 is that Citadel ends up messing up and that causes the squeeze. Either their algorithms end up malfunctioning and pushing the price up of AMC again, or something happens with their HFT algorithms again buying too many shares. Where they end up marking the price incorrectly, whether they end up buying too many shares to close out of or roll their FTDs, whether they end up trying to roll their married and divorced puts, and again, accidentally the algorithm messes up. There's many different reasons that obviously could cause the price to spiral out of control. As Ape News tweeted, he said, furthermore, if Citadel and Virtue can manipulate markets with high frequency trading, where billions can trade in less than a tenth of a second, on the flip side, when something arbitrary happens, it can cost them billions in less than a second as well. And catalyst number 4 that we have at the moment, which is therefore least likely, is that the SEC from somewhere gets a massive burst of confidence and goes after Citadel and shuts them down for market manipulation once and for all. Again, we can all dream. So I think that right now AMC as a stock and all the data points are in a great position, and we do have a bunch of catalysts that could end up or will end up causing the squeeze. So what are my updated price brackets and have they changed? Well, first I want to start by talking about this tweet from Suspended POS, where Adam Arons said that once you destroy the short thesis, these shorts will be forced to cover their 135 million shorted positions. We know that back in June of 2021, they only closed like 20 million legally shorted shares on the run to $72 per share. So therefore, if all 135 million shares or million legally disclosed shorts and all of the synthetic shorts are closed, you're going to get a run at least to $200 to $300 per share. That's bracket 1, as it always has been. If closing 20 million shorts takes you to $72, then closing 135 million shorts right now today takes you at least to $72, if not significantly past that to $200 to $300. Now, I also think it's going to really help to split down my brackets into pre-reverse split and post-reverse split, depending on when the split actually happens and depending on when the squeeze actually happens. So first we have bracket 1, which is $200 to $300 per share pre-reverse split, which seems logical based on solely the legally disclosed shorts closing out of all of their short positions. There was 135 million AMC shares purchased to close out of all of those short positions, with zero selling or zero shorting transactions going through as well. I'd imagine the stock would at least push up to $200 to $300 based on the run to $72 being caused purely by only 20 million shorts being closed out of. Now again, brackets 2, 3 and 4 really depend significantly based on how many synthetic shares there actually are in existence. I think if there's another billion synthetic shorts that have to be closed out of, the price could very also easily push up to $500 to $1,000 per share. Again, if there's say 2 to 5 billion synthetics like there seems to be, give or take at the moment, that all need to be closed out of at the exact same time, the price could very easily push to between $5,000 to $10,000, again pre-split. And again, if there's a crazy figure like 10 to 20 billion synthetic shorts that all need to be closed out of at the same time during forced margin calls or forced liquidations, the price could very easily reach above $10,000 per share, again pre-split. Now again, for my post-split brackets, you basically take all of those individual brackets and times them by 10 for the 10-for-1 reverse split. Now obviously this is a very rough calculation as it doesn't take into account the impact that would be seen by the ape conversion and also by the settlement as well. So I guess post-reverse split, my brackets move to $2,000 to $3,000 for the first target, which again seems reasonable based on the all-time high for AMC now being $720 per share. Bracket 2 moves to $5,000 to $10,000, bracket 3 from $50,000 to $100,000, and bracket 4 $100,000 plus. Now obviously I'm not saying all or any of these brackets are guaranteed to happen because who knows how many synthetics are actually out there. Who knows whether they would all be closed at exactly the same time during forced liquidations or not, and who really knows exactly how this squeeze is going to play out because it's a once in a lifetime opportunity. Again, I'm not saying that all of these are definitely achievable, even in a squeeze circumstance where we do have over 20 billion synthetics. I may end up selling some shares in brackets 1, brackets 2 and brackets 3, and I may end up missing bracket 4 entirely and not sell a single share in bracket 4 because the price may not reach above $10,000 per share. Hey, again, we may not even see bracket 3 or bracket 4 either. I may be stuck with a bunch of shares left after the squeeze that I did not sell off during bracket 1 or bracket 2. But ultimately, those are my brackets, so be sure to let me know down in the comments below what your brackets are. And as always, guys, be sure to ding that notification bell because that way you'll be alerted when I upload a new video. Cheers.